Welcome to the ReachX podcast. Today we are with Simon Watkins, a noted market commentator, author and analyst. His latest book, An Insider's Guide to Trading the Global Oil Market, has just been published by ADVFN Books. Simon, welcome to the podcast. Let me just jump straight into the first question. The coronavirus has infected 50-odd countries. There's been a market upheaval. So what should those in the oil and gas markets, and by extension the commodities market, make of it, and how should they approach their own trading?
Well, there are two key elements to this. One is the mortality rate, and the second is the disruption rate to demand, at least potentially. So on the first point, the mortality rate for coronavirus is currently believed to be around 2 to 3%, at least that's how it's manifesting itself. So you actually stand much more chance of, if you're in the US, which is a place virtually unhit thus far, you stand a greater chance of dying from just the usual flu with related pneumonia than you do from the coronavirus. And in fact, most of the types of flu that against which people are inoculated, again, carry a higher mortality rate. If you look at similar scale epidemics, that is those that have had a major effect on markets, H5N1 bird flu had a mortality rate of just over 52.8%, Nipah virus 77.6%, and that was in 1998, and 2002 SARS 9.6%. So the point is, the actual mortality rate, frankly, is not a market moving issue. The latter point, which is demand disruption, in order to contain the spread of coronavirus, countries that have been heavily hit, like China, obviously, and indeed South Korea, have had to implement lockdowns of various things, cities, factories, refineries, for example, in the oil industry. So that has a detrimental effect on demand, which is disproportionate to the mortality effect. So in China, for example, just on the oil front, there are those, and with some justification, who are saying that yes, the mortality rate may be 2 to 3%, but the actual demand disruption may be as high as 20%, which means that is how much they're expecting demand from China to fall in the next quarter, and indeed this quarter.
In your book, you describe the oil market's global importance. We enjoyed reading it, and I think one of the key things there that stands out, you've described oil as the lynchpin for trading other commodities, equities, bonds, and forex. Now, for what it's worth, 2020 is turning out to be a pretty challenging year to suss out or to do your guesstimates, whatever terminologies where you use. But from where you sit, Simon, I think one question one of the listeners would have is, why is the oil market subject to more macroeconomic and political influences and factors compared to, say other markets?
Well, it's got two elements again to it, which is that you've got political factor and an economic factor, both of which are obviously often inextricably linked. So on the one hand, you've got the oil producers, or oil and gas producers, whose power in the world, geopolitical power, is founded specifically on the amount of oil that they have or not. And on the other side of things, you've got the oil consumers, whose economies are obviously founded on the price of oil and whether it goes up or down. And so you've got two interesting facts coming into conjunction right now. You've both of which pertain to the US specifically, but have knock-on effects, obviously, given the centrality of the US dollar and US economy to the world economy and also world markets, which are twofold. Firstly, 70% of the price of gasoline, roughly, is derived from the price of oil. And for every $10 per barrel change in the price of oil, there's a resultant 25 to 30 cent change in the price per gallon of gasoline. And for every 1 cent that the price of gasoline goes down, $1 billion, an additional $1 billion of consumer spending, makes its way into the UK economy, and vice versa. So if it goes up, $1 billion is taken out. So 25% move, that's $25 billion. So that's on the one side of things. And going into an election, as Trump is, and all the candidates, You do not want to be pushing oil prices up or in any way complicit in pushing oil prices up because of the detrimental effect on the economy that I just outlined. If you look at the statistics since the end of the First World War, 11 out of 11 sitting presidents have been re-elected in the US if the economy was not in recession within 24 months of the election. But if it was, only 2 out of 7 have been re-elected. So it doesn't take a genius to work out that lower oil prices, broadly speaking, and the resultant more healthy economy for the US improves your chances of being elected president. In fact, Bob McNally, who was a senior energy advisor to George W. Bush, said that any spikes above $3 per gallon of gasoline makes presidents very nervous, and in fact, anywhere near 4, and they should be packing their bags, ready to leave Pennsylvania Avenue. And a $4 per gasoline price basically equates to around 120-ish in current circumstances, 120 to 130 per barrel of Brent crude.
Right, I think, and as you allude to it, it's a tricky situation that the market finds itself in, and of course the oil is the linchpin of a lot of other asset classes. You draw a direct connection between that and consumers' pockets. Now, oil is a story of demand too, and we notice the oversupply in the market is very well documented. But now, courtesy of the coronavirus, we're all sort of scrambling around to see what demand forecasts we come up with. That everybody's wants to be at the top of the pile, trying to register declines on how they would revise their demand forecast downwards. But still, from where we sit, it looks a bit too conservative or complacent at the moment. Or does the market have the problem that a lot of these demand forecasters, given that the coronavirus is an emerging situation, are perhaps shooting blind?
Well, it's a bit of both, really, because, firstly, a great rule of thumb in trading is always ignore all forecasters, or most of them at least, because they're always talking their book. Saudi Arabia, for example, obviously one of the big 3 oil producers, it needs an oil price of above $84 per barrel of Brent, just simply to balance its budget. And if it doesn't, if the price is not there or higher, it's going to be in a budget deficit on a sustained basis till probably 2028. So that it has its own story to tell. The point is illustrative of the fact that each of the major contributors to the oil matrix, the pricing matrix, weaves their own tapestry, and Russia needs an oil price of $40 per barrel. US shale producers need 40 and over to make good profits or hedge out profits in the future. So you always see this in the advance of OPEC meetings, and we've got one coming up on the 5th, is that they all sketch their own particular demand and supply equation. So the reality is China is by far and away the biggest demand source for oil. Historically, certainly over the last few years, it's taken in about sort of a 10-ish million barrels per day of oil, roughly. And the smart money is focusing really on the fact that it could be a 20%, as much as a 20% decline in demand over this quarter and perhaps the next. But then it's a V-shaped recovery I'm expecting, because China's one of the advantages or disadvantages, depending on how you look at it, has the political will and the money from various areas to throw at the problem. So at the moment, yes, there are refineries idling. There is a lockdown in some places. There's displacement of the workforce. But according to international scientific belief, China may have peaked in terms of the coronavirus. So yes, you have a lagging effect in terms of economics. Will it sustain? Probably not. So you're talking about maybe a maximum 20% decline in demand from there. On the other side of for 2 quarters. On the other side of the equation, You have a constant fiddling of the quota allocations for the OPEC deal by OPEC members. Obviously we know who they all are. You also have supplies that are not built into the figures coming from Iran, via Iraq often, and Iraq itself, and Ecuador, and Nigeria, and Venezuela, and Libya, and so on and so forth. And Russia, of course, does whatever it wants. So there's a massive supply in the market that is not documented and built into the figures. So net, I think the pessimism, which is essentially talking their own book anyway, is slightly overdone on the demand side. If you take into both, accounts the actual demand picture and the supply picture as it's probably going to manifest itself.
I think that there's a lot of conjecture out there that things will get considerably worse before they get better. In the book, I noticed that you've treated recessions past and their impact on oil demand and on impact on investment, in fact, in the oil and gas business. Now, taking that into context, and you see what's happening around us now with the coronavirus and all sorts of panic all around, dare we mention the R word for this year? And another snippet I'd throw in is, it's getting a bit boring to always look to the Fed at times like these.
Well, up until really the end of January of this year, the smart money, by that I mean people who, some of the hedge funds and some other players as well, some of the really experienced traders at some of the good investment banks, they were assigning even as high as 50%, that's 50% chance of a recession within the next 6 months at that time, so by the beginning of the second half of this year. That pre-coronavirus had dropped to around 10%. Now, where it is now is that it's in a strange sort of melting pot, because what I mentioned about the supply and demand balance of oil, of the oil market, pertains as well to the supply and to the supply and demand balance, essentially, of all other asset markets, and the appetite to buy into markets and to take that risk, as it's compounded by the coronavirus element. So, in terms of the recession now, I personally think, and some of the people whose opinion I do respect on this matter also think, there's about a 10 to 15% chance of a recession in the next 6 months. I think the 15% is for my more pessimistic colleagues, but I'd say 10. And let's say there was, then yes, the Fed, it is boring, but really it's the only option, because the Fed is where the money is. The Fed is what sets the interest rates essentially around the globe by comparables. And although interest rates are low, there are a number of instruments that the Fed still has. There is interest rate adjustment, of course, available. There's more QE if required, and there's other direct measures. So I don't think that. I certainly don't think the coronavirus or anything like it will push the world into recession. I think China, the demand will come back in the second half of this year, a V-shaped recovery, as I mentioned, and I would discount the Fed. I would discount the idea of recession. And I also don't think that Trump is going to allow any recession to. Obviously he's not a skilled economist. He's just going to say we don't want a recession. So then lots of people scurrying around avoiding recession. And part of that, incidentally, feeds back into the oil price scenario, which is that lower oil prices are a boost to the US economy and the economy globally. And there's no real reason why, no reason at all, why oil prices shouldn't stay at around this level, maybe trickling back up towards the 50 floor that we've seen for a long time. But lower, at that edge rather than the ceiling of 70 as was.
Sure. And it's been a fascinating discussion, but in order to sort of round off, I think I cannot escape the point about oil-linked currencies and, of course, the dollar strength or lack of, and what does that mean for barrel prices? So, first question, of course, is really what do we make of the dollar strength or lack of when it comes to the price of a barrel? And then secondly, how do we, and of course we take you back to your oil hunting ground, how do we approach trades for oil-linked currencies such as the loonie, the ruble, the Colombian peso, or the Norwegian crown? So what are your thoughts?
Well, in terms of where we are on the trading side, well, let's start with the dollar, which is that the dollar is essentially, yes, there have been ups and downs. Of course, it's one of my old foreign exchange trading colleagues said they're not door numbers. They do move and change. So the dollar has gone up and down, of course, but I mean it's been on a sustained uptrend basically since about 2014 actually. Even earlier slightly, but the correlation between the dollar and the oil price has changed actually. So 20 years ago, basically the higher the oil price, the higher the dollar, and the idea was that obviously in order to buy oil as it's priced in dollars, you needed to aggregate dollars, and that demand would push the dollar up, obviously. So simple supply and demand. But over the last 10 years, that's switched, and this is what remains in place, this paradigm, which is that it's opposite. So the oil price goes up, and generally the dollar goes down. And the reason for that is explained by the fact that the oil price, the effect of oil in the US economy is extremely pronounced. It's a major effect, so it's a 50% effect on some of the key leading indicators. So as the oil price goes up, it has a deleterious effect on the US economy, and thus on the dollar as emblematic of that economy. So people sell it. Now, this brings us on to the other. So ergo, in answer to one part of that question, I would always be buying dollars until the Chinese turn around, of course, and sell all the trillions of dollars of debt they've got. But until they do that, nonetheless, I'd be a buyer. And in terms of the other currencies that you mentioned, there are some key currencies that you can always. It's just they're just there to make either direct profit trades or hedging trades or whatever, or options as well. Within option structures, they're cracking trades, which is the Canadian dollar, of course. There's 15% of its 15% of its economy is based on oil, but actually nearer 50% of its receipts come from oil and oil-related products. So, I mean, and the other good thing about the Canadian dollar is that actually it does move directly with the oil price. Nearly, or I say directly, pretty much. And sometimes, by the way, there's a nice arb there because you get the Canadian dollar working in one direction with the oil price, but the TSX, the Toronto Stock Exchange, moves in the opposite direction. Sometimes they discombobulate, so you can trade the difference and just wait. You can sell the TSX if the Canadian dollar is going down. There is a technical reason. It's basically to do with the structure of their companies. So that's one thing. I'd always be looking to sell the Canadian dollar. In the scenario we have currently. The Norwegian kroner, Norway again, 50% of its economy is tied up with oil and oil products. It's a natural sell when oil prices are trending down. Ditto Colombian peso is an overlooked one, that actually, because yes, they do have, obviously, there's a lot of metals accounting for their metals receipts accounting for their in their GDP, but actually oil accounts for about 45%. Oil and oil products, 45% of its economy, and that moves again in direct relation to the oil price. Positive correlation. And there's the Russian ruble as well. It's much more difficult to get hold of, but if there is a chance, you should be selling that. What else have we got? Norwegian, we said the loonie. There also one overlooked actually, and I was looking at this recently. It's well worth looking at, which is the Aussie dollar. And the Aussie dollar, that does have a lot of oil and oil-related products in it. But there's an interesting play because sometimes there is a divergence. Obviously, there's a ratio between oil and the gold price, and Australia has a lot of gold in its export. So there is a slight there's a correlation there, but it has to be balanced against the gold price as well, and the ratio. Normally the ratio is about 15 or something like that. So any discordance there, and you know whether to sell yours or buy it.
Thank you very much for your time, Simon. I think we've covered a lot of bases in this sort of 20-minute discussion. Ladies and gentlemen, that was our latest ReachX podcast. For more details, go to reachx.co. Thank you for listening.